Recently at the dentist's office, while paying with our HSA card, I realized many people aren't clear about the difference between an HSA and an FSA. Both accounts give you tax advantages for medical expenses. An HSA has three main ones: pre-tax and tax-deductible contributions, tax-free growth, and tax-free withdrawals. An FSA offers pre-tax contributions and tax-free withdrawals, but no tax-free growth. There are also other important differences, and the best resource to know them all is the IRS publication 969. Let's review the main ones. So what do these terms mean? HSA stands for Health Savings Account, and FSA stands for Flexible Spending Account. Just by the name you can tell they're different. Both are tax advantage accounts you can use to pay for medical costs like doctor visits, prescriptions, dental, and vision. In addition, HSA also cover Medicare premiums, COBRA payments, and some long-term care premiums, while FSA generally cannot be used for insurance premiums. Who sets up the accounts? With an HSA, you open the account yourself, usually through a bank, broker, credit union, or an HSA provider. With an FSA, it's different. Your employer sets it up as part of their benefit package. You can't open the account yourself. Note, when you open an HSA account, make sure there are no monthly charges for having the account, as some companies may charge you a monthly fee for having one. Who owns the account? An HSA belongs to you. The money and the account are yours, and it stays with you even if you change jobs or retire. An FSA belongs to the employer. You can use the funds, but the account itself doesn't follow you if you leave the company. Who's eligible? For an HSA, you must enroll in a high-deductible health plan. If you don't have that type of plan, you are not eligible. So what counts as high deductible? For 2025, the IRS defines it as a plan with at least $1,650 deductible for individual or $3,300 for families. You only have to qualify under one. And the maximum out-of-pocket limit for individual has to be $8,300 or $16,600 for families. The other criteria to qualify for an HSA are: you can't have other healthcare coverages except for few exceptions, such as having specific dental or vision care. You can't be enrolled in Medicare. And finally, you can't be claimed as a dependent on someone else's tax return. For an FSA, eligibility is much simpler. It's offered through your employer along with other employer-provided benefits as part of the cafeteria plan, and it doesn't require a specific type of health plan. PPOs, HMOs, and marketplace coverage all qualify. How many people actually use these accounts? To give you an idea how common these accounts are, about 36 million Americans have HSAs, covering more than 70 million people, while FSAs are offered by many employers with about 1 in 6 families using them. Even though HSAs have higher contribution limits, only about 55% of people with high deductible plans contributed money to their accounts. In total, about 37% of Americans report having either an HSA or FSA. What if you are self-employed? If you're self-employed, you can open and contribute to an HSA, but not FSA. To open an HSA as a self-employed individual, you would simply need to purchase a high-deductible health plan on your own, such as through the marketplace. However, only certain plans adhere to the IRS rules, so you have to double-check that they qualify for HSA. FSA, on the other hand, are employer-based. If you're self-employed and don't have access to an employer benefit plan, an FSA isn't an option. Let me show you how to check if a healthcare plan is highly deductible and qualifies for HSA by going to healthcare.gov. Select the Browse Plan and Costs, then type in your zip code and select the county. You should provide your family and income information for customized selection, but for now, I will just go to see all the plans. I am starting with 41 plans because I didn't add much detail. To verify that your health plan is considered highly deductible, check the deductible amount and the out-of-pocket maximum. For example, this first plan has $8,500 deductible amount for individual, which falls into our highly deductible plan criteria. But the out-of-pocket maximum is too high. It is above the maximum of $8,300 for individual. Therefore, I can tell that this plan will not qualify for an HSA. Now, you don't have to screen the plans manually though. An easier option is to select the Add Filter button, then check the Eligible for an HSA checkbox. Once you apply the filter, only plans that qualify for the HSA as high-deductible health plan will remain. And you can see that only one plan on the marketplace for the specified county qualifies. Always review the plan brochure and confirm that the individual deductible and out-of-pocket maximum meets the HSA eligibility requirements before enrolling in the plan. Who can contribute to the account and how much? With an HSA, both you and the employer can contribute, as long as you stay within the IRS annual limit. For 2025, the limit is $4,300 for individuals and $8,550 for families, with an extra $1,000 allowed if you're age 55 or older. An interesting point about HSAs is that contributions don't have to come from you or your employer. Anyone can contribute on your behalf. For example, if your mother gave you $2,000 to deposit into your HSA, which is amazing, you would still get to claim the tax deduction for it because the account is in your name. Additionally, HSA eligibility is determined month by month. If you only have a qualifying plan for part of the year, your contribution limit is prorated to those months. With an FSA, contributions are usually made through your payroll deductions, though some employers may also add funds. For 2025, the IRS limit is $3,300, though your employer may choose to set a lower cap. Now, how are distributions handled? For an HSA, any withdrawals you make are reported to you on Form 1099-SA. On your tax return, you use Form 8889 to show how much you took out and whether these withdrawals were qualified medical expenses. If you use the money for non-qualified expenses, that amount you withdraw will be subject to income tax and may be subject to an additional 20% tax. There are exceptions though. There is no additional tax on distributions made after the date you are disabled, reach age 65, or die. Surprisingly, you can reimburse yourself from your HSA for qualified medical expenses from past years, as long as the expenses were incurred after you opened the HSA. If you keep the receipts, you can pay the bills out of pocket now, let your HSA balance grow, and withdraw the funds later, tax-free. Note, if you do itemize your taxes, you can deduct qualified medical expenses as an itemized deduction on Schedule A that are equal to the tax-free distributions from your HSA. Basically, no double dipping. For an FSA, distributions are handled directly through your employer or plan administrator. You either request reimbursements by submitting receipts or use the FSA debit card, which is tied to an approved expense categories. Now, what is the record-keeping burden for each account? With an HSA, the responsibility is on you. Contributions are reported by the bank or custodian on Form 5498 SA. If your employer contributed, that will show on your W-2 in Box 12 with code W. You also claim your deduction on Form 1040 Schedule 1 for personal contributions, which reduces your taxable income. You're expected to keep receipts and proof of qualified medical expenses in case the IRS audits you. With an FSA, your employer or plan administrator checks expenses up front. You usually need to submit receipts or an explanation of benefits before being reimbursed. Even if you use the FSA debit card, you may still be asked for receipts later. Contributions aren't reported to the IRS. Instead, your W-2 wages in Box 1 will be reduced by the amount you elected for your FSA. And sometimes the amount is also noted in Box 14 or in a benefit summary. Note, neither you nor your employer pays federal income tax or FICA, Social Security and Medicare taxes on amounts contributed to a health FSA. Let's walk through the 2024 tax forms you may get for HSA contributions and distributions and how they show up on your tax return. Example: Jane is single and had a high-deductible health plan in 2024. She earned $51,000 for the year. Her employer contributed $1,000 to her HSA through pre-tax payroll deductions. Jane also added $1,500 on her own with after-tax money. For these contributions, she received Form 5498 SA. During the year, Jane used some of her HSA balance from prior year contributions to cover medical costs. She took out $500 in total, of which $400 went to qualified medical expenses and $100 was spent on non-medical items. For these withdrawals, she received Form 1099 SA. Note, all these forms that I'm going to show you and numbers are just examples for illustration. Let's review the W-2 form. We know Jane's salary was $51,000, but Box 1 lists $50,000. That's because her employer's $1,000 HSA contribution, which is shown separately in Box 12 code W, is excluded from taxable income. She doesn't pay federal income tax, Social Security, or Medicare tax on that $1,000. On her Form 1040, line 1A, her wages are reported as $50,000. We also know that Jane contributed $1,500 of her own after-tax money to her HSA and received Form 5498 SA. Box 2 lists total contributions toward the HSA plan from any sources. We know that Jane contributed $1,500 herself and her employer contributed $1,000 through her payroll. So we see a total of $2,500 in that box. Note that some sources say that only the employee contributions would be listed here, while others say that total HSA contributions for the year would be listed. This form is mainly informational, and it often gets mailed out late in April or even May. Box 6 confirms the type of account, in this case, an HSA. So how does Jane claim her deduction? She has to file Form 8889 along with her tax return. On line 2, she lists her own $1,500 contribution. On line 9, she reports her employer's $1,000 contribution from her W-2. Line 13 calculates the total deduction, but only her after-tax contribution, the $1,500, is deductible, since the employer's part already received tax benefit, being pre-tax. That amount that she can deduct is transferred to Schedule 1, Part 2, as an adjustment to income, which is listed on 1040, line 10. That reduces her AGI and lowers Jane's taxes owed. Now let's look at how Jane's used her HSA during the year. She received Form 1099-SA for her withdrawals. Jane took out $500 in total. $400 went to cover qualified medical expenses, and $100 was spent on non-medical costs. Box 5 identifies which type of account is being reported, and in Jane's case, it's her HSA. Box 1 shows the total gross distribution for 2024. In Jane's case, it's $500. Now, Jane has to report her $500 withdrawal on Form 8889, Part 2. Line 14C shows the $500 distribution. On line 15, she reports that $400 was used for qualified medical expenses. That leaves $100 as non-qualified distribution, which is taxable as regular income. Because Jane is under 65 and not disabled, she also owes a 20% penalty on the $100. That shows on line 17B of Form 8889 as $20. Here's how it all flows through her tax return. The $100 of extra income goes on Schedule 1, Part 1, line 8F. From there, it carries to line 8 of her 1040, which increases her adjusted gross income. The 20 penalty goes on Schedule 2, Part 2, line 17C, and then to line 23 of her Form 1040 as an additional tax. Let's review the entire 1040 for her. On page 1, Jane's wages are $50,000. That's her 51 salary minus the $1,000 employer HSA contribution that was pre-tax and excluded. Adding in the $100 of extra income from her non-qualified HSA withdrawal brings her total income of $50,100. She also gets to deduct her $1,500 personal HSA contribution. That's reported on Schedule 1 and Form 8889, and it lowers her adjusted gross income to $48,600. After subtracting the standard deduction of $14,600 for a single filer, her taxable income is $34,000. On page 2 of her 1040, line 16 shows her regular income tax of $3,851, which is automatically calculated. She didn't claim any non-refundable credits in that section, but she has been assessed $20 additional tax on the $100 non-qualified distribution, which increases her total tax due to $3,871. However, that's not what she actually owes to the IRS. Jane had withholdings from her job and prepaid her taxes during the year by $4,500. Since she paid more in than what she owed, she is due a refund of $629, but she's happy about that. What is the contribution deadline? With an HSA, you can adjust your contributions anytime during the year, up to the IRS limit, even up until tax filing day of April 15 of the following year. With an FSA, you pick your contribution amount during open enrollment, which is usually late fall for the upcoming year, and it's locked in unless you have a qualifying life event like marriage, divorce, or birth of a child. When are the funds available? HSA billed as contributions are made. If you save $500, you can only spend $500. FSA, on the other hand, makes your entire annual election available on the very first day of the plan year, even though you're paying it back gradually through paycheck deduction. Let's go through an example. Let's say we have Mark, age 32, who knows his family will spend around $2,500 this year on prescriptions and braces. He elects that amount for his FSA during open enrollment. The full $2,500 is available to him as of day one, so he could pay the orthodontist right away and spread the cost across his paychecks. Now, what happens if you don't spend everything in your FSA or HSA during the year? HSA rolls over year after year, and the money is always yours to keep. FSA usually follows a use it or lose it rule. Most leftover funds vanish at the year's end. Though some employers let you carry over up to $660 in 2025 or give you a 2.5-month grace period. Can the money grow in each of the accounts? Yes, in an HSA. Once your balance is high enough, you can invest in mutual funds, ETFs, or stocks. On Fidelity HSA page, you have an investing comparison tool that shows you how your money can grow tax-free, almost like a retirement account. For example, investing $100 a month for 30 years, which is a bit of a stretch, could grow to about $121,997, compared to $38,126 if you just left it in a savings account. Obviously, the more you contribute up to the contribution limit, the more it could grow. The way you could invest is by choosing the type of HSA account you would like and what type of funds you would select. The funds available differ across providers, so you do need to do your due diligence. Returns aren't guaranteed and there is risk, but long-term investing usually outperforms regular savings. On the other hand, FSAs don't grow. They're designed for spending, not investing. What about age and retirement? For an HSA, you can't contribute once you enroll in Medicare, but you can keep your existing balance. If you withdraw money for non-medical use before age 65, you will pay income tax plus a 20% penalty. After 65, though, you can use the money for anything. Medical expenses are tax-free still, and non-medical withdrawals are taxed like regular income. For FSA, there's no retirement benefit. The account ends when you leave your employer, and funds don't carry into retirement. Can you ever have both? Sometimes. You can't have a regular health FSA if you also have an HSA. The IRS doesn't allow it. But you can pair an HSA with a limited purpose FSA, the type that only covers dental or vision. That lets you save your HSA for long-term growth while using FSA for near-term costs like eye exams or dental work. Let's wrap up the strategies for HSAs and FSAs. HSAs are best if you have high-deductible plan and want to save for the long term. FSAs work better if you have predictable short-term expenses and want the immediate tax break. If you don't need the money right away, a smart HSA strategy is to invest the maximum each year. Pay medical costs out of pocket and save your receipts so you can reimburse yourself later while your money grows tax-free. Thanks so much for watching.